Okay, ladies and gentlemen, how's everybody doing? My name is John O'Donnell. I'm the Chief Knowledge Officer at Online Trading Academy. I assume you can hear me okay. Great. Welcome one and all. I assume you can see my slides as well. And give me a little bit of chat feedback. Make sure you can hear me okay and can see my slides. And let's get into this talk. One of the things I'd like to talk about are why do bubbles form? Why do bubbles repeatedly form, and why do bubbles burst? If you take a look at NASDAQ, if you take a look at crude oil, if you take a look at the home builders, if you take a look at the bond market, and of course, history is littered with markets that have gone through boom-bust cycles. And there's a great debate raging in the world today. Boy is new picture. Let's see what I can do here. You were sharing your desktop. Can anybody see my screens okay? According to my, you can see it okay? Okay. All right, fine. And by the way, how long is this supposed to go? Am I supposed to speak about 45 minutes? Is that correct? I don't want to go over time and step on the next presenter's time. So would somebody at administration there at FX Street let me know how long, what I'm supposed to, terminate this. So let's get into this. Bubbles are part of markets. Bubbles happen virtually all the time. If you take a look at, let me see if I can't, you can never make the same mistake twice when dealing in markets, because the second time you make it, it's not a mistake. In fact, it's a choice. All of us have a requirement to learn from our mistakes. We're all going to make mistakes. We're all human. But at the end of the day, I want you to think about this. If we're not learning from our mistakes, and I mean you and I as traders, and I mean our political leaders and the elites that are running the world in various economies, mistakes are going to get made. And unless we, as a culture, and specifically as traders engaging in these markets as professional risk managers, really can't learn from our mistakes, then we're obviously doomed to repeat them. We see a lot of crazy stuff going on in the world today. Did we learn anything from the NASDAQ bubble that burst in first quarter of 2000? Did we learn anything in the boom-bust cycle in oil that we've experienced recently? Did the home builders as an industry, did they learn anything? Did we learn anything in the financing of real estate as an asset class? If not, we're going to continue to make the same mistakes going forward. I'd like to think we've learned something. And what about central banks? Our central banks across the world, in their coordinated effort to make available cheap liberal credit, have they learned anything? Does history tell us anything? Like, for instance, can you solve a debt problem with more debt? I mean, if you really think about it, I'm not convinced we've learned anything. At all. What are we seeing today? We're seeing Western Europe, America, and Japan in either recession or virtually tipping into recession. And take a look at Germany, allegedly the strongest, one of the very strongest economies in Europe. You can see on the left scale that their market composite output index is down below 50. That's not good. You can see on the right scale, they now are moving toward 0% growth of GDP. And if we take a look at the other allegedly vibrant economic producers in Western Europe, and this is France, they don't look much better. Quite frankly, I guess we could make the case they're already worse. Their market composite PMI is down below 45 now. Again, anything below 50 is getting you in trouble. And we see that their GDP has already moved into negative territory of about a negative 1.5%. So we're in deep trouble. We see 70% of global GDP. If you take the combined GDP, Western Europe, America, and Japan combined, we're experiencing today about 70% of global output in very, very serious economic stress conditions. And so what are the central banks' response to this? Dramatically lower interest rates, kick the can down the road to the next generation, and try to solve a debt problem with more debt. I'm not convinced, I don't know about you, maybe we should do a poll. How many of you think that model's going to work? I'm not convinced it's going to work. I'm convinced if you look at economic history is littered with situations where people have attempted to solve the debt problem with more debt, and it definitely doesn't have a very good track record. And if you take the time to study, and we'll take a look at some economic markets over time, what does this mean for us as traders? What it means for us at Online Trading Academy is, for those of you that have followed Sam Seiden's work and other presenters here at FX Street, we're always looking for professional grade supply and demand zones. And what it means for us is establishing trading plans to identify these supply zones and short sell these high probability unsustainable rallies. You can tell by the look on all these charts, if we were to connect the charts, we see a series of higher lows and a series of lower lows. And we could say the same thing about Germany, couldn't we? We're basically, at best, we could say about Germany, they're in a stall speed. And a stall speed, you know what that does to an airplane. It doesn't work very well. What's the problem in the United States? The cumulative problem, as I see it, in the developed world today, the headwinds, and I think the U.S. is the poster child for the problem. And U.S. is important to the global economy. Why? Because, well, we're only 5% of the world's population, but yet we consume over 24% of what the world produces. So the producers of the world, both in the developed and emerging world, need America's consumption pattern. But how historically have we financed our consumption pattern? This is the problem, the real there are two serious headwinds we face in America that I don't think Obama's going to fix, and I don't think the central bank is going to fix. The first headwind, and I think this headwind that I'm about to describe is across the whole developed world, which is where 70% of GDP is produced, is one, a declining and aging population very quickly. And the demographics are pretty simple. As people age, their consumption pattern changes. Older people, I should say. I'm 66-year-old. I guess I have to be careful how I phrase that nowadays. But as you enter your 60s, and a greater percentage of the population across the developed world is in that category today than ever, their conspicuous consumption pattern shrinks. And that's natural. The kids have left the nest. They may have downsized their career. Their income has probably leveled off, in some cases declined, and therefore the consumption pattern is going to shrink. This is the second headwind that we face, is just an accumulation of too much debt. So regardless of who won the American election, whether Obama or Romney, I don't think the next president is going to solve an aging demographic problem and decades of accumulation of too much debt. Now, what does this look like? We've had 4 consecutive years of deficits in America in excess of $1 trillion. Since 1970, this is pretty much what the revenue of the federal government looked like, growing from virtually a quarter of a trillion to 1.9 trillion of revenue in blue. But our spending has accelerated from roughly a balanced budget of the 1970s, where income kept up with outgo, to today to where we have this substantial deficit. In this particular case, the difference between 3.3 trillion of spending and 1.9 trillion of income is roughly $1.4 trillion. And there are some staggering forecasts by CBO, Congressional Budget Office, on how this expanding deficit. Now, how does the government finance this deficit? Well, they're basically kicking the can down the road. They're borrowing money from the world savers, about half our treasury bonds, and we have about $16 trillion of GDP in America and nominal terms, and we have about $16 trillion of federal debt alone. But the total debt in America, this total headwind of the accumulated debt, is over 360% of GDP. So I don't see that you solve a debt problem with more debt. I don't think we have an income problem in America. I think we have a spending problem in America. This is just too big a gap, and obviously, I don't think you have to be a PhD in economics to figure out this is grossly unsustainable. And Europe's in about the same boat, and quite frankly, Japan's in worse case. Mohammed El-Arian, the analyst, co-CEO at PIMCO, the world's largest bond trading firm, likes to call America's economy the cleanest dirty shirt in the laundry. And I think that's very descriptive. America's got its problems, but the rest of the developed world is in worse shape than America. And I think it's going to get worse in Europe before it gets better. We got our problems, but the rest of the world has its own problems. Now, why is the debt problem not going to get solved easily? In other words, there's going to have to be some austerity. We've had accumulation of decades of deficit spending, and the American political machine has promises the taxpayer that you just can't keep. It's impossible to keep unless you're just going to ad nauseum print up fiat money and just dilute the currency to where it has virtually zero purchasing power. And I don't think that's a real solution. If I recall, in Western Europe and the Weimar Republic, then in Hungary at a later date, they've tried that, and that experiment didn't work too well if you take the time to go back and study monetary history. But let's take a look at the 2012 breakdown of this. We've got revenue at about 2.6 trillion coming in from Medicare, corporate income, Social Security, and individual income taxes. And then we've got outgo of 3.7 trillion. That makes up this $1.1 trillion deficit that we've been looking at. Forecasted to grow, by the way, to over 1.8 trillion over time by various pundits. Where's the outgo coming from? Where are the cuts going to come from? I mean, if you really want to think about it, if you wanted to go back and try to shrink this deficit and reduce spending and raise income, how would you do it? Well, first of all, you have to grow the economic pie. If you want to raise income, you get tax producers. You've got to grow the economic output. And we'll take a look at that in just a moment on what is the government's take of it. So you got to grow the pie. And how's it going to take place? And secondly, you got to cut spending. Well, where's the cuts going to come from? About 19% of the 3.7 trillion of spending of the U.S. government, about 19 trillion is in defense. Let's assume some of that could get cut. 16% of the spending is non-defense. We add those two together to get our discretionary category. But here's what's mandatory. Here's where the big challenge is. It's mandatory. We're obviously going to have to change Social Security. It's probably going to have to be means tested, and for certainly people under age 50, they're probably going to have to take a serious haircut on the benefit. We're probably going to have to cut Medicare and Medicaid under the same condition. And we've got other mandatory spending that adds up to another 18%. Net interest on our debt, only 6% of our spending. But if we get a spike, if the bond vigilantes show up and we would get a spike in interest rate like they experienced in the sovereign debt category in Western Europe, then this net interest expenditure is really going to escalate. So the big challenges to cut are going to be in the area of defense. Can we pare down our defense spending? And can we pare down this mandatory spending in the areas of Social Security, Medicare, and Medicaid? That's where it's going to have to come from if we're going to get any semblance of shrinking this gap. And then we have to do the right things economically to grow the pie economically. If you want to put some data, this is going to be recorded by FX Street, so you can stop and look at this data if you want to. But if I take those same numbers and put some dollar figures behind them on what we just talked about, adding up to 3.7 trillion of expenditures and 2.5 trillion of income, you get a pretty good idea of where the income's going to come from, and where the expenditures are going to have to get cut. It's pretty straightforward. There are going to be no simple solutions. There's going to be pain for everyone. It's not going to be pretty, but it needs to get done. Yes, you're right, Fernando. I think it is very revealing. As a matter of fact, I think we could make the case that the problem in Europe is more advanced because of socialism. Well, we've got less socialism in America, but we seem to be heading down that track. And of course, Japan's economy is what I like to call a bug in search of a windshield economy. Of the three regions of the world, Japan by far is in the worst shape, and that is not going to end very pretty. So what is our trading plan here at Online Trading Academy? We'll get into that before the end of the seminar today. And I do wish somebody in admin would tell me, nobody's told me, when is this supposed to end? Let's talk about the 5 truths that I've embraced, and I would hope all of you would embrace. And let me know if you disagree with any of these. I don't know if you can read this too well, so let me read it to you. Number 1, these are 5 truths that are very difficult to disagree with, regardless of where you live in the world, or regardless of your political affiliation. 1, you cannot legislate the poor into prosperity by legislating the wealthy out of prosperity. You see, if you take more money away from the wealthy, less money is going to get to the poor, because it's the wealthy that generally provide the capital to create new enterprise and create new jobs. Number 2, yes, the wealthy will get poorer by taxing them at a higher rate, but the poor will get poorer as well. Number 2, what one person receives without working for, another person must work for without receiving. It has to come from somewhere. There is no free lunch. Number 3, the government cannot give to anybody anything that the government does not first take from somebody else. That's pretty straightforward. You see, the government produces nothing. The government takes from the productive sector. Number 4, you cannot multiply wealth by dividing it. It's pretty straightforward, isn't it? And number 5, when half the people of your country get the idea that they do not have to work because the other half is going to take care of them, and when the other half gets the idea that it does no good to work because somebody else is going to get what they work for, that is the beginning of the end of a nation. And I really want you in Europe to think about this very carefully. Because Europe, Western Europe specifically, has the heavy burden of government in every aspect of their life. And it is my position personally, I'm not speaking necessarily for Online Trading Academy, but for myself personally, this is the root of the evil of why we face these terrible economic headwinds. These 5 principles, I think most of you will have a very difficult time disagreeing with. Now, if you disagree with any of them, please type into chat which ones you disagree with. Let's move on. In the United States, I believe we're going to see, at best, 2 to 2.5% economic growth. And I could make the case, depending on how this fiscal cliff challenge is handled, we'll talk about it in a moment, that we very well, only one of 2 things is going to happen in this fiscal cliff matter in my mind. One, because wealth is being created at a very anemic pace across the developed world, because the GDP in America, and remember, we're the primary engine for consumption for what the rest of the world produces, because our GDP is going to be lucky to grow at 2% in nominal terms, perhaps 0.5% to 1% in real terms. And by the way, anything below 2% nominal growth is a stalled economy, and we know what happens to an airplane when it stalls. We're going to continue to have these headwinds of too much accumulated debt that has to be dealt with, which will be painful, and this aging population challenge, where a substantial component of our population is shrinking their consumption profile, which means it's not going to be easy to create any new jobs. So what's our trading plan here? Our trading plan is simple. There are going to be rallies in industries that are heavily credit dependent. And I think these rallies are going to rally into what we call the Online Trading Academy supply zones. If you're not familiar with our supply and demand zones, just go back to FX Street and do a search under Sam Seiden, our VP of Education. He's published and recorded multiple webinars. Matter of fact, he's won several awards at FX Street for his work that he shared with the FX Street community on supply and demand zones. There must be 50 different webinars published there on this topic, and I encourage you to go back and review them, and then contact an Online Trading Academy office for more information on that topic if you'd like more details. But at the end of the day, these deficits are going to continue. These are some of the projected budget deficits. I don't have a lot of faith in government projections because I'm probably a little jaundiced about this, but I'm afraid they politicize all these projections. And that's just what we're going to have to live with. This is what real GDP growth looks like. And let me take a look at this on another scale. You can see that we're in rather a 1-decade decline of real GDP growth. And for those of you that are not familiar with the term real GDP, it takes a nominal GDP and subtracts inflation, and it shows you that the economy needs to grow. Now, historically, our economy has grown at a 3.1% growth rate. And we have a $16 trillion economy growing at 3.13% on average, and then the growth rate drops down to 2% or 1.5%. You can see that is just not a satisfactory condition to create a lot of new jobs and grow the pie. In fact, if you take a look at the public debt problem that we have, now, again, we have a $16 trillion economy in the U.S., we have 16 trillion of public debt, and then we have another 50 trillion of total debt in the system. So if you take the federal debt away from the total debt of 55 trillion, we're roughly 40 trillion of debt that's not federal debt. And this is what public debt is forecasted to grow to from the CBO's projection. Now, what I find very interesting about this public debt, in 2007, CBO was forecasting debt would grow to about 55% of GDP. And then in 2009, they upgraded their forecast to 90% of GDP. And now they've forecasted our projection of public debt to grow to over 100% of GDP. So you can see that the Congressional Budget Office, the CBO, has not done a very good job of forecasting public debt. But I'm here to say that the biggest problem, Boyke's asking me a question, I don't think quantitative easing is going to work. They've tried quantitative easing 7 times, arguably 9 times in Japan since 1989. The Nikkei's gone during that period of time from 38,900 down to about 8,800 today. So I don't think quantitative easing is a solution. Not only that, the housing market in Japan is down 60% peak to trough and has stayed down for over 22 years, Boyke. So I'm not convinced, again, that there's any evidence you can solve a debt problem with more debt. And I'm not convinced that you're going to just inflate the currency away by destroying the currency. You know, there's 2 functions of a currency. If you look up the definition of currency, it's to be a medium of exchange and a store of value. Now, the dollar's been a good medium of exchange since World War II. You can take it anywhere in the world and buy goods and services. The problem is it's been a terrible store of value since 1913. Since 1913, the U.S. dollar has lost 94% of its purchasing power. So I'm not convinced you're just going to dilute the currency and make it worthless. I think they tried that in the Weimar Republic. They tried it in South America several times. And what you end up with is a lot of social chaos. It sounds simple, but there are serious socioeconomic ramifications when you destroy the specie currency of a given country. I don't think it's going to work. And at what point do the bond vigilantes show up when they figure out they're going to be loaning money to a sovereign government, get paid 20 years later in a diluted currency that has no buying power? That, quite frankly, is a very sophisticated form of default, is all that really is, if you think about it. We talked earlier about the problem of half your population receiving government benefits. This is a table many of you probably have never seen before, but in the United States, the root cause of our problem, and we seem to be following what I call the Western European disease of socialism, where a greater and greater percentage of the population receives government benefits. In the United States, this is not the principle that built this country. This is not the principle that created the world's economic engine. This is not a sustainable business model for America, and something's going to have to change. Take a look at this. Over 49%, over 148 million Americans now live in a household receiving some form of government benefits. What I want to see is less government intervention into the American household and more individual responsibility. I think that is the condition that built America to becoming America. And you're going to see this is going to have to change, and we'll see who has the political leadership in Washington, D.C. to take this on. When the heavy hand of burden of government is in your pocket too heavily, there is an incentive to produce less. The average American has to work 107 days, or almost 30% of the year, to pay the government. Now, I know in other parts of the world, that's a larger percentage. But there's a lot of, what a lot of Western European countries have learned is that when you have heavy hand burdens of taxation, people find methods of tax evasion and tax avoidance. And take a look at Greece. I've never been to Greece, but it's my understanding that the world's most popular sport is soccer or football, but in Greece, the number one sport is tax evasion. If you're an average American, it will take every penny you earn from January 1st through April 15th to pay your taxes for the year. Only what you earn from April 18th on would be yours to keep. That's a difficult problem. In Portugal, it's 50%, and I'm telling you that's one of the reasons that they don't collect much taxes, Fernando. At the end of the day, people find ways to avoid taxes or tax evasion. They end up in black markets, under reporting income, over invoicing. It's a big game. It's a charade. I am told in Greece and in other parts of Western Europe, Southern Europe specifically, that physicians and attorneys pay very, very little in taxes. That they have methods and ways and means around tax avoidance and tax evasion. And you wonder why you're running these humongous deficits. You know, people, and the same thing's happening in America. When the heavy hand of government shows up on your doorstep, people will find ways to avoid paying the tab. Just doesn't work. Now, because of this heavy headwinds of too much accumulated debt and an aging population in America, look what's happened to our employment to population ratio. In the last decade, or in the last 12 years, roughly 12 years, we've seen our employment to population percentage drop from roughly 64.5% down to approximately 58%. And this is going to continue to fall, in my opinion. Matter of fact, I think what is high probability news that you're going to see on and about first quarter of 2013 is the NBER, the National Bureau for Economic Research, which is a scoreboard for when we're in and out of recession, is going to announce that we are in recession right now, that America is in recession, although allegedly our recession ended in July of 2009. Do any of you feel like the recession ended in July of 2009? I think you're going to see that we are in recession right now. Okay. Carlos asked this question, but if tax cuts are supposed to be an incentive for economic growth, why such low rates of American economic growth in 2000 compared to the 90s when tax rates were much higher? Let me tell you what you're missing, Carlos. What you're missing is something known as an effective tax rate. In the 1990s, in the 1980s and 90s, we had what is known as a tax shelter industry. And even though tax rates, the gross tax rate was higher, there were multiple tax hedges that one could participate in to minimize the tax impact. And in fact, we had a lower, what is known as quote unquote effective tax rate. So, that's I understand why that can be very, very confusing. But at the end of the day, it's pretty simple. Are you going to create more jobs by leaving money in the private sector? Are you going to create more jobs by giving the money to the government, hoping that the government's spending, after they whitewash it through their overhead model, is going to go create the jobs? The solution to job creation in America, now I can't speak for Western Europe or Japan, but I believe it'll probably hold true there as well. But the real job engine for America is the small business sector, not the big business. It's small businesses that are doing the innovative work. People forget that Microsoft at one time was a very innovative company that was started in a recession, and it was like 3 guys working out of a cubicle. You know, people forget that Google was started in a recession. So at the end of the day, it's the small businesses that are innovative that can really create the job engine, not the big businesses, and certainly not government. We need to create more private sector incentives for small businesses to create jobs. Okay? And I'm sure it doesn't necessarily work in Japan, but I'm here to tell you, America used this model for 2 centuries, and it worked very, very well. I'm here to tell you the biggest burden that I see in Japan is not only an accumulation of too much debt, but an accumulation of too much socialism and an aging population. And when you take those three metrics and put them together, and the heavy burden of government regulation really stifles the creation of small businesses. We have we have offices in London, and I know that the rules we have to follow about operating our business in London are much different about hiring and firing people versus the rules we have to follow in America. And it's a real challenge. And until you cut off the head of aggressive socialism, you're not going to find an easy solution to fix the problem. So here's what we're looking at. I just don't have them handy here, but let's just put it this way, Boinky. Because of medical technology, we're living longer, and the population is aging. And after the baby boom, those born, there's about 72 million of us born between in the baby boom category, born between 1963 and 1946. But remember, after the baby boom, after World War II, we had a baby bust. So there aren't enough workers coming behind this big bolus of population going through pig through a python. And there just aren't enough workers to support all the people that are retiring. We've got 10,000 people retiring a day in America. Okay? So let's take a look at federal deficits. This is what we're looking at going forward. These are deficits as a percent of GDP. And, we're starting to have deficits very similar as a percent of GDP, and that's really what you have to look at it. No, I wasn't in favor of the bank bailout at all. I think you should allow the inefficient banks to fail. I think we should have also allowed General Motors to fail and be reorganized by the private sector. Let's take a look at this. These are federal outlays. You can notice that from 1970, going from Jimmy Carter to Ronald Reagan, to George Bush, to Bill Clinton, you notice that federal outlays as a percent of GDP ran approximately 20% of GDP. Since Barack Obama's election, federal outlays have run closer to 25% of GDP, and we're not seeing that this lift in government spending has really created any more jobs. Now that's what the data looks like, and it's not really creating any economic growth. So the solution is not for the government to spend more money. The solution is not for the government to borrow and spend. Again, my thesis of what I want to talk about today is you don't solve a debt problem with more debt. If you want to grow the economy, it's got to be done through the private sector. Now, Obama is going to, if we go through this fiscal cliff problem of eliminating the Bush tax cuts, you're going to see these federal government outlays really grow. And it's going to, one of two things I believe is going to happen on this fiscal cliff issue. Either the powers that be are going to solve the problem between now and the end of the year with some spending cuts and some modest tax rises, or the politicians more likely will kick the can down the road, defer it for 6 months, argue about it for another 6 months, 6 to 8 months, until they find what they perceive to be the perfect solution. One of two things is going to happen, but it's in the next 45 days we're certainly going to find out, aren't we? If I had to bet on what's going to happen, nothing's going to happen between now and the end of the year. They'll basically defer it, kick the can down the road for another 6 months, and then readdress it in June. We'll see what happens. Other than looking at federal tax revenue, I think a better way to look at federal outlays as a percent of GDP is to look at it federal outlays as a per capita. Back in the 1970s, adjusted for inflation, our federal outlays were only a little over $6,000 per capita. It grew under Ronald Reagan, Bush. Under Reagan, Clinton, it got flat to about $8,000 per capita. Bush stepped it up to over $10,000 per capita, and Obama's got it moving up around $12,000 per capita. Again, I haven't seen, remember, we've been in recession. We've been in a secular bear market from first quarter of 2000. If you adjust the S&P and the Dow for inflation, and I've got some charts on that if you'd like to see it, we've been in a secular bear market with a series of cyclical rallies that have failed since first quarter of 2000. So stepping up federal outlays per capita, and our population's not growing that much, was not necessarily a prescription for economic health and growth. Okay? So what's been the impact of all this deficit spending, quantitative easing 1, 2, 3, and infinity, propping up the zombie banks and corporations? Well, we've had deflation. This is the CRB index, the Commodity Research Bureau index. It's obviously peaked in 2008 at over 450, and today it's trading at about 306. We have principles of deflation virtually everywhere. So I believe I was supposed to end this. Nobody ever told me when I was supposed to end, but the memo that I had received was this would run about 45 minutes. If that's the case, my time is up, but I would like to tell you that Online Trading Academy, just go visit at tradingacademy.com. Okay, thank you, Wiki. Is there to serve you. You can always give me a call. Just go to our website. I'm in the Irvine, California office. Let me type in my email address. My email address is john@otahq.com. I've got a whole series of webinars that I have produced over and above this. I'd be happy to send you a free copy of. And of course, Sam Seiden has a ton of webinars that are produced and hosted there at FX Street. Let's see if I can answer any other questions that you might have. Are there any specific questions you'd like to talk about? Or you want me to, keep on going a little bit? Cancel the next guy. Thanks for the answer, but it's hard to embrace which economic philosophy is more effective when looking at track record. You can see success and failures from the implementation of both schools of law, supply side and Keynesian. Well, let me help you out, Carlos. If you really want to embrace which is best, forget the Keynesian stuff and go to this website, Mises.org. I am a follower of the Austrian School of Economics and have been for 40 years. I started out as a Keynesian, and I'm here to tell you if you're looking for economic truth about what's right and what's wrong about Keynesian economics, you need to go to Mises.org and really study the work. Now, if you want a great book to read, it's called Economics in One Easy Lesson by Henry, I'll type this in, Hazlitt. You can get this book on Amazon for about $10. And it really lays out the difference between the two for the layman to understand. I'm here to tell you I've been following this economic story for over 40 years. And I'm here to tell you if I wanted to sit down with my children and grandchildren and teach them the truth about economics, I would get them this book, Economics in One Easy Lesson by Henry Hazlitt, and I would tell them to abandon Keynesian economic principles, which is based on a simple principle. You can solve a debt problem with more debt, and you can inflate the currency in lieu of taxation. I do not believe that is sound economics. The Austrian School of Economics that predated Keynesian economics was started in Vienna in the late 1800s, and I really think these people understand and have it right. So just get this simple book. Economics in One Easy Lesson by Henry Hazlitt. You can get it at Amazon.com, or you can get it at Mises.org website. It's a simple, readable book. It was written, believe it or not, in 1946. It works extremely well. Henry Hazlitt was a very famous columnist for the New York Times, and the genius of his work is the simplicity and clarity of his writing on this particular topic, and you will have a lot of information. Okay. We're going to close in 2 more minutes. I want to tell you that we do have some I'm going to be giving a free class on OTA's core strategy for real market timing for income and capital preservation. I'm going to be giving this in an hour, in 10 minutes. I'm going to be giving this talk. And all you need to do is go to www.tradingacademy.com. I'm going to give a talk, and you're asked to sign up for a free class. And if you'll put in your zip code or a country of origin, you can get a free pass to this seminar I'm going to host. I'm also going to do it next Tuesday. If you'll email me, John at OTAHQ, perhaps I can get you an invite to come to this free seminar. It's going to run for about an hour and a half. I'm going to talk about OTA's core strategy for real market timing for income and capital preservation. I've enjoyed being with you. God bless you all. Good luck. Hey, I hope all your trades are green.